Hey everyone, my name is Jack. Welcome back to the channel. I cover a variety of topics as they relate to personal finance, real estate, investing, and all that sort of stuff. So if you like that sort of content, be sure to have a look around the channel. And if you like what you see, be sure to subscribe. But today I want to talk about the decision between investing in your state versus out of state when it comes to real estate investing. For those of you who follow the channel, you'll know that I recently closed on my first ever rental property, which was a deal out of state for me in Indianapolis, Indiana. I currently live in Chicago, Illinois. I want to talk a little bit about why anyone would make the decision to invest out of state, outside of their area, or outside of the 30-minute radius that's often pitched by a lot of investors. And not everyone's decision is going to be the same, so I definitely wanted to kind of go over the different criteria that you should look at before you make a decision either way. Now, of course, whether or not it needs to be said, I am not a financial advisor, and this video should not be taken as financial advice, just hopefully gets you thinking about your different options when it comes to investing in real estate. But everyone's situation is different, and your decision may not be the same as mine or many other people's. And before you invest in real estate, the first question you have to ask yourself is whether you want to be an investor or a manager. And what I mean by this is someone who invests in real estate and is truly an investor is one who puts their money into the business and then has some other system put in place to take care of it. Whereas a manager is the person who actually runs the day-to-day of managing the property and keeping operations going. Now, some real estate investors are also self-managers in that they manage their own investments. And that does take a lot of time, but it also saves them a lot of money. Maybe you want to become a property manager and you want to run your own properties. Maybe you had relatives who did that and it inspired you and you wanted to do the same thing. You understand the business. You think you can provide a lot of value doing that. Go ahead. That is a great opportunity for you. It's just like any other job, really. You're working to solve the needs of your customers, which in this case are your tenants. But rental property management definitely is not for everyone since it's very stressful. I spent a couple years doing property management while I was in college and then also about a year and a half after college as well. And it is a very stressful business. You're dealing with problems all of the time, and it's your job to stamp them out quickly and provide solutions without hesitation. And the bigger your property empire gets, it becomes very tedious at times to try and manage all of these problems at once. Whether they be big problems or small problems, there is always a steady stream of problems for property management teams to take care of. When you're managing the property yourself, you are the person doing everything. You're not going to have other people to rely on to manage the property for you, unless, of course, you want to build a rental management company, in which case you'd be running the company and having managers below you and whatever. But still, you're in the business of property management, which is very different from being a complete passive investor. A true passive investor, on the other hand, would hire a manager to do the management for them. So when I was working in property management, I was managing on behalf of someone else. In this case, it was a company, and I was working for that company to manage their properties so that the shareholders of that company wouldn't have to manage it themselves. I had to put a lot of time into the job along with the rest of the management team to make sure that the properties were up to snuff and also were always staying occupied, as we had lots of vacancies to fill just because it's the cycle with residential properties. Every 12 months, your lease expires typically, so every now and then you're going to have a vacancy, no matter how big your property is, and you have to be ready to fill those vacancies. And the more properties you have, or the more units you have, the more vacancies you're going to have to fill. So that was my job, was filling those vacancies along with my coworkers to keep this thing running smoothly. Meanwhile, the shareholders didn't really have to do much. They just provided their money, and the money was used to buy properties, and then we would manage it for them. It was very passive in that way for them. So that's the decision you have to make first. Do you want to be a manager, or do you want to be a passive investor? You can be both an investor and a manager, but you're not going to be passive, obviously, since you have to do the work yourself. So once you make that decision, then we can get on to the next part. If you want to manage yourself, you're going to limit yourself geographically, since it doesn't make any sense to buy a place to manage if you're going to be having to drive 6 hours to get to the property to take care of a minor issue. That does not make any sense. When you're self-managing, you have to be close to the property. You can't do these super long commutes because you're the first line of defense. You're the first person that the tenant's going to contact to take care of a problem with your property. And you have to be there if the problem's serious or even if it's not serious. Who else is the tenant going to call? You're going to be the one who has to take care of that property regularly, so it doesn't make sense to invest super far away if you're going to be managing yourself. So if you want to manage your own properties, you really don't need to see the rest of this video unless you are thinking about potentially moving into passive investments, because you can still manage properties near you, but also have an out-of-state portfolio at the same time to supplement your income and your investments that way. Which brings me to one of the first benefits of investing out of state, and that's having geographic diversity. Geographic diversity means that if one area of the country that you're investing in real estate in goes south for whatever reason, you'll have another area where your properties are still doing fine to make up for it. If you had one rental property in every single state, the chances of all 50 states suddenly collapsing at the same time are very slim, at least when we look at history. But if you had all of your portfolio in one town and then something happens to that town, maybe a natural disaster, maybe a giant employer leaves, maybe there's some government regulation that really destroys the rental market, all of these things could happen in a lot of areas. So having all of your eggs in one basket is very risky in that way. But when you invest in different states across the country or even across the world, your real estate portfolio has a lot of diversity built into it to take care of that sort of risk. You can actually take a look at the breakdown about the first Tesla bubble that I did where the stock price went super high way back in the spring of this year. And I actually talked about diversification there and why an investor in the stock market would want to diversify into many companies. But the same principles apply to real estate and other asset classes. So go ahead and take a look at that video if you're at all interested. But in addition to geographic diversity, you also get a sort of deals diversity. Whereas if you're in one area that has only very expensive deals available, you can look in other areas when you invest out of state that might have much cheaper deals or deals that make a lot more sense given your financial goals. Because there's really two types of markets when it comes to investing in real estate. There are cash flow markets and there are equity markets. Now some markets are a mix between the two, but that's generally the two poles that they go towards. There's equity versus cash flow, and both have their benefits and both are very useful depending on how you use them, but not everyone really cares about a ton of equity. And similarly, a lot of people with a ton of cash might just want to park their wealth and allow it to build over time via equity. They don't really care about the cash flow. Maybe they have dividend income from elsewhere. So those are the two benefits that you can go for, and not every area will offer both types of deals in great amounts. So you can take my case. I live in Chicago, which I would generally consider an equity market in that it's much more expensive than your average area throughout the country where there's a lot more potential for cash flow in those other areas. Not that there aren't deals that could cash flow well in Chicago, it's just there's not as many. There's a lot more equity upside when it comes to doing something like a flip or something like that. But for my first set of deals, I really want to focus on cash flow. I want to get towards financial independence. And while equity is great, especially in a market time like this where I'm a little unsure as to how strong that equity would be in the short to medium term, I'd rather go for cash flow that would be stable and could cover any debts should anything go bad. And that way I also have money coming in to replace any income that I might lose should economic times get bad and I lose my income source. So that's another decision you have to make, whether you want to go for cash flow deals or equity deals. And if your market that you live in right now and that you are planning on investing in doesn't offer the type of deal that you're looking for, it might make sense to look outside of that area and look into other states or other cities even within your state that might be far away that would have those deals available to them, which is what I did. I decided to invest in Indianapolis, Indiana, which is much more of a cash flow market compared to Chicago and also has a lot of better things, in my opinion, going for it economically, just at an aggregate scale. So I thought for a long-term investment focused on cash flow, Indianapolis seemed like a good play to make. There are other markets that are like Indianapolis. There are other markets that are like Chicago. There are other markets that are in between or well beyond those types of markets as well when it comes to cash flow or equity. When you open yourself up to investing out of state, you also open up the floodgates, if you want to call it that, of all the different types of deals out there that you might not have in your specific area. And the last really big benefit that I think investing out of state really forces you to work on is systemization and taking yourself out of the business. If you're trying to scale a rental portfolio, what's most often your biggest limiting factor once you get to a certain amount of properties, it's going to be you and your time. If you're actively managing all of your properties, you can only manage so many at once before it just gets too overwhelming. You only have so many hours in a day. When you take yourself out of the business by hiring other people to take care of the work for you, suddenly you unlock your time again, and you can start investing and scaling things and looking into areas of your business to work on to make that business more feasible for an even bigger scale. Now, this might not be important for someone who doesn't want to scale a rental portfolio and just wants 1 or 2 properties, but even then, being able to systematize your investment business means that you can use that time that you would have been spending on it on some other venture or more real estate or more whatever you want to do with that time. Time is one of those few assets that's truly finite and that none of us can get any more of. Unlike money, where you can get a bunch more money by doing all sorts of things. And thankfully, we have many opportunities in this world, even during hard times. There are opportunities to make money. They just might be a little hard to find, but you definitely can't go and find more time. Whether you're very spiritual or not, the amount of time you have is not going to change. Maybe it's destiny, maybe it's whatever, but typically you're not going to live past, we'll just say 120 years of age if you're one of the super freaks who makes it that long and lives a super long life. But otherwise, you're probably looking at about 80 to 90 years if you're a healthy person, and maybe much shorter, unfortunately, and you never really know. I personally want to make that time count, and I don't want to use it towards managing rental properties. I already did a few years of it. It's alright, and I certainly learned a lot of great skills from it, but it's not something I want to do for the rest of my life. I want to use my time towards other things, so I think it's worth it to pay a property manager to take care of the problems with the property and just check in with them occasionally to make sure things are going as planned. So even though I do have the time to manage a few rental properties, if I wanted to invest just in my hometown, I decided that I want to make sure that I can build systems to make sure that when I buy another property out of state or buy another property even in state, that I know that I don't have to be there if I don't want to be. That's not to say I don't care about the business. I very much care about it, and I spend a lot of time thinking about it for sure, but it's very different than actually having to go and do it yourself. If I think of something, I can ask my team about it and ask my team to take care of a problem if there's something, and then I can focus on doing what I'm better at, which is looking for deals and actually getting better at becoming a good real estate investor. In short, I don't want to be my own limiting factor. I want to make sure that I can build a team to take care of day-to-day problems with my properties that I'll eventually own, including the one I have right now, and using that as the base to launch a much greater business off of. And investing out of state doesn't have to be reserved for veterans. I did it for my very first rental property deal, and I know someone else can do it too, even with less real estate experience than I had. I did have a couple of years in property management and as a real estate agent, but I know that other people can definitely start with investing out of state if that's really what they put their mind towards. Anyways, that's all I've got for today. I hope that helps to understand why an investor might choose to invest out of state. If you're thinking about investing out of state, I'd definitely love to see your questions in the comments below. But if you like this sort of content, definitely leave a like since it helps the channel out a lot. Be sure to subscribe so you don't miss any more real estate content. And until next time, take care.